Hey, my name is Steven Speck. I'm one of the managing partners here at Rust Bowl Capital, and I wanted to thank you for jumping on to this presentation today. And what we're going over today is a presentation I put together a little while ago called Smart Investing. Now, the reason I put this presentation together was because when I started getting into investing, I found it really challenging. I think a good phrase that really kind of sums it up is I didn't know what I needed to know, and I didn't know that I didn't know it. Another way to put it is I didn't know the right questions to ask, and I really didn't have a mentor. And so I kind of wanted to put this presentation together. It's kind of like a high level overview to kind of shine a light on and illustrate what actually is smart investing, or what actually is investing outside of all this finance bro stuff, or Facebook posts that you can get in, and Facebook groups and all that type of stuff, and kind of give you just a really good intelligent view of what investing is by an actual professional who does it for a living full time and has their own professional investing firm. Okay. So the title of this presentation is Smart Investing. What we're going to cover in this presentation is why do we invest? Make sure that we have a good reason for that. We're going to talk about what is the best investment. And then after the best investment, what are all other investment options that we have available to us? We're going to talk about then some core concepts or ideas that pertain to all investing that are really the fundamental forces of investing, right? They're physics has like core ideas that illustrate everything else. Immutable rules. Well, investing has the same thing as well, kind of immutable rules that kind of make why investing works. Okay. Then we're going to cover a question that I get a lot, and that is, can you actually beat the market? Okay, the market being the S&P 500, can you outperform that? Can you get a better return per year over a long period of time than the S&P 500? Lastly, we're going to finish up with a really hot topic, which is real estate. A lot of people are really excited about real estate the last couple of years, and so we really are going to hit that really home and kind of talk about some truths and some fallacies about that. So, first things first, why do we invest? Well, typically when we think about investing, people just they don't really know. Maybe there's not a concrete answer when it comes to investing, and that's a dangerous place to be. So, a lot of times, if we do start to get an answer, it's something along the lines of like we want freedom over how we live our life, or we want control. What do we have access to? What does our family have access to? We want to have greater freedom over that, or optionality. For example, I was able to take 2 weeks off this year, go to Montana, and go with one of my buddies and go see Glacier National Park. Now, if you've never seen Glacier National Park, literally, it's like, I don't know. You'll probably believe in God after you get back because it is that amazing. Okay, so I was able to do that though because I have a good investment portfolio that backs me up and gives me that optionality over my time. And so that kind of topic, when I talk to physicians who invest with us, say ER doctors, for example, this topic comes up a lot. They say, I really love what I do, being an ER doctor, and sure, the pay's okay or whatever, but I wish I could work less and make the same amount of money because then I would enjoy actually encountering and doing what I'm doing and helping people instead of just feeling like I'm just getting burnt out all the time. And I tell them, man, that's why we invest so that we have alternative revenue streams coming into us. So maybe a question to ask yourself when you're asking or you're trying to figure out why are you specifically going to invest is you need to answer what type of life do you want to live? Okay. And I have this philosophy that investing isn't about retirement. It's not just about building a 401k or anything like that. It's about creating the life and the opportunities you want and can dream of for yourself and for your family. For me personally, that's why I invest. And for you, when you sit down and kind of are quiet with yourself, that's where you're going to figure out why you are investing, right? And here's a couple answers to the question of why to invest that are really terrible. For example, it could be like, I want to be a millionaire. Okay, that doesn't, what? I want to be rich. Okay. I want to retire. Like the reason these are bad, whys is because none of them are discrete. And therefore, if it's not a discrete goal, it's unattainable, right? Because the goalpost always moves and you're always worried about this vague thing of feelings and emotions. We want to get away from feelings and emotions. Typically, when it comes to investing, emotions are your enemy, not your friend. Okay. And then on top of that, like, I want to be a millionaire. I want to be rich. Like, it's not discrete. It's not really a vision goal, like not saying vision board, but like it gives you nothing that engages you or inspires you into the life that you want to have. Right. So I came up with a better example when I put this presentation together, and it was I want to create a $1 million net worth within the next 5 years so that I have the money to take 1 day off a week. Okay. Why is this a much better example or answer for why you want to invest? Well, number one, it gives you a discrete goal. No emotions are involved. You either hit it or you don't. It gives you a time frame too, so it keeps you accountable. 5 years. Your goal is $1 million net worth, 5 years, and then it gives you a reason why as well. Okay, the reason is so that I take 1 day off a week. Okay, so when you hit this goal, the goalpost doesn't move. You can then take 1 day off a week, and you should take 1 day off a week because otherwise you're lying to yourself, and you don't want to lie to yourself. Um, Okay, so why do I actually tell you this story? Okay, so the reason I tell you this isn't because, this is a cliche explanation of, just telling you something just to tell you something or just to fill up space, but it's because I actually lived this. So I studied neuroscience, cognitive neuroscience, in university in my undergrad. And I remember my junior year having a tremendous frustration about my life. I wasn't overly fulfilled. I felt behind, and I felt as though I wasn't making progress like I wanted to in life. And you see, there was this problem, which I just told you. At no point before had I clearly lined out what I wanted my life to look like. Everything was vague and abstract. It was all based off of feelings, comparisons, comparisons to others, and not in relation to any discrete goal. Of course, this was the problem. I had nothing real to measure my progress against. This is the reason you must create a good why. Because if you don't have a good why, you will either get discouraged and quit way too early because investing takes longer than you want but goes faster than you think, or you will not know when you actually reach your goal. Okay. That's another big problem. You want to be able to reach your goal and celebrate it. Okay. Remember, money without use is useless. Nobody really wants money. They want what money can buy. Okay. So now that we got through, why do we invest and actually coming up with an answer, Stephen, what's the best investment? Well, the quickest way to the highest return is by investing in either your business or yourself. Okay. So this, once again, might sound really basic, really stupid, something like that. But if you're a young kid, okay, you're just out of college, or maybe you're in high school or something like that, and you're coming to me and you're like, Steven, what's the best investment I can make? I'm going to say yourself. Here's an example. Okay. So one day I went and got coffee with a financial advisor, right? And he wanted to talk to me. I'm like, cool. We'll go grab coffee and talk and chit chat. And I said, I've had a couple young people in their 20s. They've come up to me and they said, hey, Steven, say I have $5,000 to invest. What is the best place to invest in? And so I asked him that question. I said, okay, whatever it was. I said, I gave him the same question. And I said, what is the best investment they can make? And his answer was, well, diversify and give it time and blah, 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 blah. And I said, well, I disagree. Here's what I would say to somebody in this situation. I'd say, first of all, answer me this. What do you make per year? And if the answer is less than $100,000 a year, my answer to them on what they should do with their $5,000 is go out and buy a skill or invest it toward the skill that can make you $100,000 a year. Not something that you feel good about, but go find a skill that can get you closer to making $100,000 a year. Because your income in the beginning is the number one thing that drives your success in investing. If you don't have any money, you can't invest. Okay. Your best investment is you. Okay. So here's another example. Here's another scenario. well-off clients, people who own businesses, they invest with us sometimes, and they'll come to me and I'll talk to them and I'll listen to them. And yes, sure, I want you to invest with me, but I want you to be successful as an individual. So I ask you a couple questions. I'll ask you about your business, how your business is going, what your goals are for your business, and stuff like that. And a lot of times, what I'll tell them is that your next best investment is your business that you already have. It's not an investment that I can offer you. It's the investment in your own business. Okay. So for example, maybe you have a small business or you have a medium-sized business, but it requires you to show up all the time. Okay. The problem is you don't really own a business. I mean, you do, but you're kind of self-employed. And if you're self-employed, me as a private equity investor, I don't want to buy a business that I then have to work at all the time. I want to buy a business that already has everything set up, already has the employees, and all I have to do is kind of give them instruction or hire a CEO or somebody to come in and take care of it. Okay. So if you're in that situation, maybe it's a physician's office, maybe it's a dental clinic or something like that, figure out a way that you can get your business to uh, where you don't have to work in it. Or maybe it's not even that. Maybe there's a small investment or a piece of equipment or machinery that you can invest in, and all of a sudden it opens up this new revenue stream for you, and it's along the core lines of your business. I mean, a lot of times those are the best investments because they're going to have the biggest return on the dollars that you're investing. So does it sound dumb? Maybe, but it's the truth. And I'm going to tell you the truth before I tell you to invest with me. So now we got that. Now I told you you are the best investment. The same stuff that Warren Buffett would tell you, the same stuff that I'm going to tell you. What are our other options of investing? So when it comes to investing, here's basically the four core other investments that you can make. Number one, you can invest in bonds. Bonds is another word for debt. It's basically lending money to a government. It could be US Treasuries, or it could be lending to companies. Like Microsoft has bonds, Apple has bonds. Obviously, the U.S. government has bonds. Every country in the world has bonds. Uh, but what bonds are is they give you a fixed return with limited downside, but also limited upside. It is what it is, basically. And then obviously there's some risk around them. Next would be stocks. And all stocks are is equity, which means ownership in a publicly traded company. So when you buy a share of Apple, you're buying ownership interest within Apple. Okay. Or I think I put down Coca-Cola. Okay. So you can buy a share of Coca-Cola and you are part owner of Coca-Cola now. Obviously it's very, very small, but you're still part owner. Now, why would you do that? Yeah, there's no guaranteed return on that, but you have no limit to your upside. So if Coca-Cola doubles in value in a year, you get 100% return done because it doubled in value. Versus the bondholders, their return is their return. Okay. So after that, you have index funds, mutual funds, index funds. And what those are is that they just invest in a large amount of different companies. They take your $1, your $100 that you're investing, or $1,000 or whatever, and they'll split it up into like 50 different investments. Okay. And they'll do all of that and manage all of that for you. And an index fund is specifically trying to match the return of a certain benchmark. So for example, think of the S&P 500. You can buy an index fund that follows the S&P 500. The best example of this is SPY. It's an ETF that is supposed to have almost the identical return of the S&P 500. Lastly, you can invest in what is called alternatives or alternative investments. This is where Rust Belt Capital works. Alternative investments are just investments that are not traded on a public market. So they're not on the New York Stock Exchange, they're not on the NASDAQ or anything like that. This could be private real estate, private debt, private equity, stuff like that. That's what we offer here at Rust Belt Capital. We offer alternative investments. Now, there's pros and cons to that. Um, Obviously, I think there's more pros than cons because that's the business that I work in and that's where I invest. So, first of all, let's go over Mainline investments. So, what are mainline investments? Mainline investments are stocks and bonds. Traditional off the shelf advice from many financial advisors, they're going to recommend a 60-40 portfolio. That is, they're going to tell you to put 60% of your investments in stocks. Mainly, these are index funds or different types of funds, mutual funds, etc. And then they're going to say put the rest or 40% invested in bonds. Now, the reason they want to do that is they want to smooth out volatility in your portfolio, meaning they don't want it to go way up and way down and way up and way down and way up and way down because, humans are emotional and that would, be a little freaky. So, just kind of give you an example of what mainline investment historical returns look like. We have 8.77% as an annualized return on average for a 60-40 portfolio. For the S&P 500, annualized return is around 10.25%, 10.29%. And then average return annualized for bonds is like 5.33%. The source of this was from Vanguard. It wasn't just information we came up with ourselves. Now, different people are going to tell you different things. If you have an investment advisor, you might have to pay them a 1% asset management fee. So knock all those returns down by 1%. And that's maybe what your net return looks like or something like that. um, let's see what else did I say. Rarely is single stock selection the main staple of financial advisors' investment thesis. This is very, very true. There are a lot of reasons for that, both good and bad. And we'll just leave it at that. So now that we kind of gave you a little bit of a benchmark and what those mainline investments look like, there are some core concepts when it comes to investing that power all of these investments on why do we invest, right? And they're time value of money, compound interest, tax shelters, and questions like how long does it take to build wealth and how much money does it actually take? So time value of money, this is the like core four principles. So this would be one of the core four principles. This is a huge idea in investing. And basically, all it says is that money today is worth more than money tomorrow. And what does that mean by that? The most basic example of this is interest paid on lent money. Why does somebody pay interest on money they borrow? Right? Because the lender is giving up the opportunity to use that money in the meantime. Therefore, they must be compensated for that lost opportunity. What else could they be doing with their money in the meantime is the question, right? So the compensation amount is equal to the interest rate the lender charges. Okay, so when you go and borrow money from the bank, uh, the interest rate is the value of that money over time. Okay, um, and this is set by the lender, so this is their value of the money over that time period. And then from this idea of the time value of money, that money is worth more today than it is tomorrow, comes the idea of present value and future value. And that's how we figure out what money is worth at different points in time. So we're not guarantee or we're not going to go into depth on really any of this, but the reason I'm saying this or highlighting this is because I'm trying to help point out things that maybe you can research in the future to go deeper. Just kind of you don't know what you should know and you don't know that you don't know it, right? I'm trying to help you out with that. And present value and future value are topics to look into. So present value just means what an investment is worth today. Future value just means what an investment will be worth at a future point in time. So uh, here's the catch. The compensation or interest rate is not the same for all people. And this is a big time or a big reason that many people, invest in stocks, bonds, uh, or alternative assets because they're worth more or less to different people. Okay. It's very important to know. And how you figure out what the money is worth to you over time is you figure out what you can make that money grow at. Okay. So for us at Rust Belt Capital, maybe just saying for an example, maybe we're trying to hit 15% a year. Well, 15% a year is what the money is worth to us then. So if we can borrow it for 7% and we can make it grow at 15%, we're going to do that. We're going to want to do that as much as our risk parameters allow us to do that. So from time value of money comes then compound interest, the idea of compound interest, or building something that builds unto itself. This is the superpower, the holy grail of investing. It's the number one thing is compound interest. So put simply, compound interest is previous earnings accrue earnings themselves. So let's think of it in this scenario. Say you invested 100,000 into something that paid you 10% interest per year. At the end of year one, you had 110,000. Now, if you repeat the investment during year two, the additional $10,000 that you earned in year one would also earn 10% or an extra $1,000. So you end up with $121,000 at the end of year two. Now, in such a short time horizon, that's not really that impressive of a return. But think of this, a 25-year-old that invests just $25,000 into an asset that makes 10% and waits until they're 65 will have $1.1 million by that time. Let me say that again, $25,000 invested into an investment that makes 10% per year for 40 years turns into 1.1 million. And that 1.1 million in year 41 will make $110,000. That is the power of compound interest. So the reason it's so powerful is because it's an exponential function if we're talking in mathematic terms, right? This means that at a certain point, the growth in the value of your investment will surpass the amount that you could earn in a year. Meaning if you invest and you continue to invest in good assets, guess what? Those investments at some point in time are going to make more money than you could ever make in a year. Let me say that again. The power of investing is that if you're consistent and you're investing in good assets, at a certain point in time, your assets will make more in a year than you could ever possibly make. And this is how you make money. The other thing that we're going to talk about is tax shelters. Now, the reason I say this is because taxes are a huge expense. And because when it comes to investing, a lot of times investing gurus, financial advisors, so on and so forth, they get talking about all these fancy terminologies for trusts and IRAs and Roth IRAs, 401ks, Roth 401ks, and all this type of different stuff, SEP and simple and all that type of stuff. And really, all they are is just tax shelters. That's it. They're just tax shelters. They're not really investing. They're tax shelters. Investing and tax shelters are different. They're just tax shelters. Okay. But are they important? Sure, because taxes are one of your biggest expense, if not the biggest expense when you invest. Uh, so if you have to have money to invest, the biggest way to increase the amount of money that you have to invest is to lower your expenses. Likely, your taxes are going to be your greatest expense, so it makes sense to try and decrease this as much as possible. And so one way to do that is to use tax advantaged accounts. Okay. Most common types of tax advantage accounts are 401ks. This is an employer sponsored investment account, meaning your employer will contribute something and you will contribute something. This account, though, in and of itself is not an investment. It's just a tax shelter. Let me repeat that again. This account in and of itself is not an investment. It's just a tax shelter. Another example of a tax advantage investment account would be like a IRA, which is an individual retirement account. This has nothing to do with an employer. It is just, once again, a tax shelter. And in and of itself, it is not an investment. It's just a tax shelter. Both of these allow for tax benefits, but come with major restrictions, limitations. Okay. Since the government's going to be so benevolent in their, you know, great geniusness, which is obviously I'm being sarcastic, uh, there's strings attached, right? So limits on your use, limits on your actual access to it, so on and so forth. The government's going to put all the barriers around it. Um, other tax sheltered Other tax shelters then preferred by wealthy individuals typically include real estate, and we'll get to why it's a tax shelter, or it's I would call it a tax shelter, um, in a little bit. Um, Well, actually, let's just talk about it right now. So, how could real estate be a tax shelter? It's because real estate allows for a large amount of the investments gains to be deferred, deferred or preferential treatment with the least restrictions, right? So that's where maybe you've heard of like 1031 exchanges and when it comes to buying and selling assets. Maybe you've heard of depreciation and amortization when it comes to real estate. This is types of stuff that you can use against the cash flow that comes off of the asset. Another word for cash flow is just the dividends that the property is paying. You can use the depreciation, which is non-cash expense in real estate, to write off against those um, dividends, and therefore you defer the taxes into the future. Why is this important? Because it goes back to time value of money. Money today is worth more than money tomorrow. Even if you're a passive investor, your money is worth more today than it is tomorrow. So if you can defer those taxes, it gives you the opportunity to use that money in some other way. Now, we want to use that money with the least restrictions. That's why Rust Belt Capital specializes in real estate. There's other investments as well, like actual physical oil wells have a lot of tax beneficial treatment, stuff like that. We're not going to get into that. That's a little bit outside of the scope of this presentation. Um, next concept that we're going to talk about though is how long, right? Patience is a virtue that not all of us have. I am a very patient person, but I don't necessarily enjoy waiting. I don't know who does, but whatever. So the question you might be having in your mind is like, how long does it actually take to get meaningful results? Logically, everyone wants to know how long it will take. The best answer to this that I can give you is that it's going to take longer than you would like, but it's also going to be a lot shorter than you think. Okay. More specifically, your specific answer lies in outlining your discrete desired outcome and working backwards. So, for example, say your goal is I want to create $1 million net worth within the next 5 years so that I can have the money to take one day off a week. So that's your desired outcome. Okay. Then you could work out on a compound interest calculator. If you need that, you can Google it. Um, in order, to have $1 million in 5 years, you would need to start with what 200,000, and then invest $9,000 a month for the next 5 years at a rate of 14%, interest rate of or a return rate of 14%. Now, you might say that this is crazy, but 14% is still. I mean, if you get the right investment, you can definitely make 14%. Um, I also say if I don't have $200,000 to start with, or $9,000 a month is too much, then you can adjust your time horizon, and then you'll still figure out how long it's actually going to take you. So maybe instead of 5 years, it takes you 10 years. Okay, but at least you have an answer. The longer the time, the more compounding helps you too. So say you take this example above, uh, and your 5 years, you're able to actually start with 200,000, invest 9,000 a month. Yeah, in 5 years, you'd have $1 million net worth, but in 10 years, it's not, you'd have $2 million net worth. You'd have a much larger net worth. And I can't tell you that off the top of my head. It's an exponential function. Um, I could probably look that up, or you can look it up on compoundinterestcalculator.gov or something like that. The other question is going to be how much to invest, right? So I already kind of went through this example before. Sometimes I get questions from young people, and they're talking about starting with $5,000 or $10,000. And that's where we're going to return to, what is your best investment? Your best investment is going to be you and getting your income to $100,000. Why? Because the more you invest, more in, more out, little in, little out. Okay. So if you want to have meaningful results and you don't want it to take forever, you're going to need to invest more money, and you're going to have good assets, right? Um, you know, the, the other question then to answer on this is how do you figure out when you should invest in other assets besides yourself? Well, you should always invest in yourself, yes, but when you're at or near the top of your earning potential, that's when you start to say, okay, I can take the foot off of just 100% investing in me and start investing in these other assets. Or say your business is already established, and you want to take some risk off the table, by adding some diversification. Okay, then maybe it makes sense to invest in some other assets. Maybe you are at a place where you're really comfortable, where you really like your income and you don't really want to push it anymore. Okay, then that's another place where you can start investing in other assets, and it kind of makes sense to do that. Um, and if you're looking for a percentage, I would say I would suggest at least 30% of your income. So $100,000, that's $30,000 a year. And so why am I saying that? I'm saying 30% because most people are told 10 to 15%. So if 10 to 15% is the average and you want to be ahead of the average, then yeah, you're going to need to invest more. To be non-average, you got to do more than the average people do. So can you beat the market? I showed a slide a little bit ago that said a 14% return, something like that. That would be, as you can tell from a couple slides earlier, that would be better than the S&P 500's average return. Can you actually do this? Is this actually realistic? From a ground level and understanding, beating the market means earning a higher return than the S&P 500. And for me to answer this question in the most simple terms, the answer is yes. You can beat the market and you can do it consistently. That said, it is hard and uncommon for reasons we can't 100% address here, because it would get into the weeds a little bit too much. Regardless, to do so, you need to know where the value of an asset comes from, right? So there's intrinsic value, and that's the value of an asset derived from the cash flows it produces, right? That's how, without getting into it, that's kind of how valuation starts. How do we tell what something's worth? How do we tell what an investment's worth? And then there's superficial value. Okay. So think of cryptocurrency. The value of an asset relies solely on how much somebody else is willing to pay for it. Okay. So when you buy a Bitcoin, your hope is that somebody else at some future point in time is willing to pay more than you paid for it. There is no inherent value within and of itself. However, when you buy a piece of real estate, as long as it's an income producing real estate, has intrinsic value. That is, whether somebody pays you more than you paid for it, doesn't really matter because you can just sit on the asset and it will continue to pay you regardless. Okay. So intrinsic value versus extrinsic or superficial value. Okay. So outperformance is typically achieved through buying good assets based on their intrinsic value, adding leverage, and holding them for time. Rust Belt Capital has a terminology for this. We could say good assets, leverage, and time. That's what we're looking for. This is Warren Buffett's, Berkshire Hathaway. That is their hallmark strategy, is good assets, leverage, and time. However, using leverage in the stock market for a long-term investment is very unwise. Why? Because you can hit a margin call. That's where your stockbroker calls you up and says, hey, Joe Schmo, guess what? Today, the market says that Apple's worth $100 a share. You paid $200 a share and you borrowed money to do that. You need to come up with extra money. Well, that's not good. That's really not good because that can wipe out your position. So going back to the 14%, do I think it's reasonable to hit 14%? If you have good assets, leverage, and time, it makes sense, right? Because if, say, holistically speaking, the stock market is a good asset, right? Holistically speaking, and you add some leverage to that. Leverage is supposed to enhance your returns. That can be good or that can be bad. Now, if we can eliminate the possibility of getting a margin call, that means we can actually implement a long-term investment strategy that uses leverage and therefore enhances our returns. This is why we deal with alternative investments. So what are alternative investments? This is where Rust Belt Capital really is. This is what we do. We're an alternative investment private equity firm. So alternative assets can be something super simple, right? So real estate is not publicly traded. Therefore, it is called an alternative. Okay. The formula to do well in investing is good assets, leverage, and time. Good assets is self-explanatory. It's a good business. Good businesses do better over time. Leverage just allows you to use cheaper money to buy an investment than your own. So if your money's worth 10% and you can borrow money at 4%, it makes sense to borrow money at 4% because you're buying an asset or an investment that makes 10%, right? You make the difference. Time, it just allows this stuff to work in your favor. It allows compounding to start working. Time value of money allows that to start working. And that's why we come up with this formula called good assets, leverage, and time. Real estate is the simplest alternative asset to execute good assets, leverage, and time that we've found, right? The simplest. And the reason we like simple is because simple scales, fancy fails. Simple means there's less ways to screw up. Complex means there's more ways to screw up. So we want simple businesses that are easy to understand, that allow our lenders to be happy to lend to us, and that we can operate very, very well. So I said this is because real estate is a simple business. The financials are generally more straightforward. Business plans, such as a value add plan, are more black and white to implement. And since real estate is not publicly traded, the market is not 100% efficient because price discovery is a little bit more challenging. And this is good for investors. We don't want a 100% efficient market to work in. Um, so then again, since these assets are not publicly traded, investors can borrow money to buy these assets with little risk of a margin call, i.e., leverage increases our returns. Finally, real estate typically provides both cash flow for its investors and tax benefits, right? This is another reason we like real estate as an alternative asset. Cash flow is king. And then we get some tax benefits as well from depreciation, amortization of the value of the property, which we've already talked about. Uh, for many of these reasons, this is why you're seeing large private equity firms like Blackstone come in and start buying up, whether it's houses or build to rent homes or it's apartment communities, so on and so forth. They really, really, really like these types of investments. So, who are we? We are Rust Belt Capital. Rust Belt Capital is an Ohio-based multifamily syndication company. I would call us actually a Ohio-based private equity firm or an investment firm that specializes in real estate currently. We acquire both core plus and value add B and C class multifamily communities throughout Ohio and the Midwest, and we target meaningfully higher risk-adjusted returns than traditional investments for investors. Typically, our investors are high net worth individuals. They're doctors, dentists, lawyers, anesthesiologists, business owners, uh, really well off business folks. And they generally like the investments that we do. If you would like to learn more about Rust Belt Capital and our offerings, which we have continuously every year, uh, would be happy to give that to you or to give you a case study on some of our investments. In order to do that, just email investor@rustbeltcapital.com. Check out our website, rustbeltcapital.com. Obviously, you're seeing this probably either on our YouTube channel or on Spotify or something like that. Um, and you can join our email list that comes out once a week for some other helpful and educational content. I hope you liked this presentation. If you did, please like, share, and subscribe, or leave a comment in the comment section, and I will try to return or respond to it. Thanks.